On your screen is the title of an article that I wrote, which was just published in the Electricity Journal in October of 2009, entitled When Revenue Decoupling Will Work and When It Won't. And that's really what we're going to talk about here today, is rather than making broad statements about decoupling that suggest that decoupling does this or does not do that, it turns out that the effectiveness of decoupling depends on the particular utility's circumstances that it faces. And when we look at decoupling with a financial lens, which is what I'm going to do today, we find different answers for different utilities. So that's where we're headed. But now the first question I have for you, and this is if you again hit your touchpad or if you click your mouse, some icons should show up at the bottom of the page. And the one over toward the right by the sound icon will allow you to take this poll. But before you answer, let me tell you what I'm asking. I'm not asking if you have a good understanding of finance, because one would not have to have taken courses in finance to necessarily know a lot about finance. There are a lot of people in the finance field that have no training in finance but still know a lot about it. But that's not my question. My question for you, and this is just for us to see what the makeup of the audience is have you taken a two-semester sequence, either graduate or undergraduate, in corporate finance and investment theory? So if you would please answer yes or no to those, and then we will get the results back in a minute, and we can kind of see where people are. Again, this is neither good nor bad. It's just a background information about the audience. Before I get into decoupling per se, I really need to make sure, and this was related to the previous poll question, that we're on the same page. Finance principles is what I'm going to use to guide me today. And when I talk to energy efficiency advocates about decoupling, we often talk past each other because we're looking at the problem from different perspectives. So I'm going to try to put us on the same footing, first of all. And then we can talk about decoupling specifically. So we're going to start out with a very simple finance quiz. And this is, as I said, a simple problem. And the analysis will get more complicated quite quickly. But just please bear with me as we step through this first quiz. Let's see if we're on the same page. You're the manager of a firm, and you own 100% of the stock. Two investment alternatives have come to you, but you can only select one. They're mutually exclusive. You don't have any idle cash, so you have to raise capital for either of the projects. And in this case, we're going to start out with debt, because debt is easier than equity to analyze. You're going to borrow the funds at a 10% interest rate, and you can borrow as much as you need to finance the projects. And here are the projects. The first one is a smaller scale project with a higher rate of return. I'll show you the rate of return in a minute. But essentially, it's a $10,000 capital investment, and you're going to get $20,000 1 year later. And then the project terminates. It's a simple one-year project. Your alternative is a larger scale, lower return option in which you put up twice as much capital and then receive $35,000 1 year later. Again, project terminates after 1 year. Well, the first one is the higher rate of return project. It generates a rate of return of 100%. The second one generates a rate of return of 75%. Those are both good returns, 175. But the first one is for every dollar invested, you get more bang for your buck. Another way to look at the projects is just to look at how big they are. And the second one is bigger. That's why it's larger scale. So what I'm going to ask you now is, which is the better option for the firm in a financial sense? Is it the first one, where we get 100% rate of return on the invested capital, as opposed to 75%, or do we just go for the bigger project? So if you would select, using your little polling icon now, down at the bottom, this question will appear for you, and you can select, I think it's the smaller scale, higher return option that's better, or I think it's the larger scale, lower return option. So if you'd make your selection now, and we can go back, let's just quickly step through it. Is it the higher rate of return project, which would be smaller scale, higher return, or is it the larger project? Okay, and while we're waiting, Andrea, do we have the polling results for the finance course? And what do we see? Okay, most people answered B, which is no, I have not had that. And that doesn't surprise me because, and that's, again, neither good nor bad. It's just that most people would not have gone through a very formal sequence because you would normally be a finance major, and not everybody's a finance major, which is probably good. But let's analyze, while we're waiting for the results to come in on the finance quiz, we're going to step through this, and I'm going to show you, I think, in very clear fashion, actually, that it's the lower rate of return project that's better for the firm. And how can I show that? Well, let's go forward 1 year. What's going to happen with the smaller project? We're going to collect $20,000. What do we have to do with that $20,000? Well, we borrowed $10,000, so we have to pay that back, and we have to pay back $1,000. So what do we have left over? $9,000. Now, let me pause here and ask you a fundamental question. How much money did you put in to this project? Well, you didn't put anything in. You financed the project. This is what finance is about. We raised capital from other investors. So you put nothing in, and you got $9,000 out. This is why the larger scale project is better. The proceeds are $35,000. We repay the $20,000 principal and the $2,000 interest, and we get $13,000 left over in our pocket. We put nothing in. We have $13,000. So would you rather have $9,000 or $13,000? That's really the simple answer here, the simple question here. And $13,000 is better than $9,000. Which project had the higher rate of return? Well, the $9,000, the project that produced $9,000, but that's not how we make decisions in corporate finance. We don't use the rate of return. Why? Because investors care. The basic principle of corporate finance is investors care about maximizing wealth, which is measured in dollars, not making high rates of return. So any measure of financial attractiveness must be produced or reported in dollars, not percentages. But think about what we just saw here. We're not putting any money in, and we're getting free cash flow of $9,000 in the first case, or putting no money in and getting $13,000 in the second case. There's no rate of return involved in this calculation at all. We don't really care how we generated that. We do care how much money we make. And this is what I call the Streetwise version of corporate finance. It's a really good practical way of looking at corporate finance. It's really about using other people's money. I've just shown you the debt case. I'm going to show you the equity case in a moment, but it works the same in either way. It's about using other people's money to generate windfall profits for the present stockholders. So let's focus on that slide. This is a key part of corporate finance. There's no rate of return in here. It's not about maximizing rates of return. It's about using other people's money, other investors' money, to generate windfall profits for the present stockholders. And Andrea, do we have the poll results from the second question? And well, it's interesting. The B is, most people actually got this correct. They actually picked the larger project. Good job on that. When I usually give this talk, most people pick the higher rate of return project. So we're actually starting off on a good foot here. But think about now let's step back and think about what you just concluded. The majority of you is that I'm not going to look at rate of return as my primary guide for investment. Good, because that's going to be very important when we look at decoupling, because decoupling focuses on rate of return. We're going to have to look beyond that rate of return measure to see if decoupling actually makes us indifferent to energy efficiency and sales promotion. I know I'm jumping ahead a little bit here. But, and for those of you who answered highest rate of return, let's see if we can actually get you over into that other category. Why do I say it's a windfall gain? Why do I say that that's what finance is about? Because that is what finance is about. If we go to Stuart Myers, The Application of Finance Theory to Public Utility Rate Cases. Here's a quote. Note that an opportunity to invest in a project offering more than the cost of capital generates an immediate capital gain for investors. And this is a windfall gain. Why is it a windfall? It's a windfall when you put nothing into the project, none of your own money into the project, and you get money out. Those are windfalls. That's the basic idea. That's actually why businesses expand. To create money this way, using other people's capital to create money. Now, again, that makes sense with debt, but what about with equity, which we're going to get to in a minute. But so this was the B, and congratulations to our audience. Most of you got this right. Here's how we do the formal analysis, though. What I did for you before to show you that the larger project was better was sort of an ad hoc analysis. Here's the formal analysis. The NPV for the small project, what is it? We have to spend $10,000, and then a year later we get $20,000 back. But because the $20,000 comes a year later, we don't just treat it as an equivalent dollar amount to the first part. We have to adjust for the cost of capital, which is 1 plus 10%, or 1.1. And when you do that arithmetic, you see that the net present value is $8,182. And when we do the large project, we step through exactly the same steps. $20,000 of capital, $35,000 comes in a year later, so we have to bring it back to today's dollars, and we get $11,818. If you'll note, remember we got $9,000 and $13,000 when we did the simple analysis? Well, $9,000 brought back to today's dollars is $8,182, and $13,000 brought back to today's dollars is $11,818. But notice that there's no rate of return explicitly analyzed here. It's all implicit. And here's a fundamental point. The rate of return is an input to a process that determines which project is better. It's not the objective. We don't try to maximize the rate of return. We try to maximize the NPV. Why? Because we'll have more money in our pocket at the end of the day. And here's the official answer from Brealey, Myers, and Allen. This problem comes from a Principles of Corporate Finance book. Both are good investments, but B has the higher NPV and is therefore better. Now, knowing that a lot of people think that we should maximize rates of return, they follow on with, if you follow the IRR rule, which is internal rate of return, you will have the satisfaction of earning a 100% return, 100% rate of return. But if you follow the NPV rule, you're $11,818 richer. Investors want to create wealth. They don't care what the rate of return is as long as it creates wealth. This is the most important slide for this first principles introduction. If you walk away with one slide, this is the one you should take with you. From Ross, Westerfield, and Jordan, Fundamentals of Corporate Finance. Given two mutually exclusive investments, which one is best? Let me pause for a second. So in other words, if the utility can be on a path in which it promotes sales, it can't simultaneously be on that path and on one in which it promotes energy efficiency. Those are two mutually exclusive paths. Which one is better for investors? The answer is simple enough. The best one is the one with the largest NPV. Can we also say that the best one has the highest return, which is a percentage? No. This is a fundamental principle of finance. And if we add Higgins' Analysis for Financial Management, this is the book that's used to prepare the financial management section of the Chartered Financial Analysts exam. It's an applied book in finance. The problem with the profitability index, which is another ratioing metric, or the rate of return for mutually exclusive alternatives, is basically that they are insensitive to the scale of the investment. We naturally want to try to make the scale the same. We say, well, I can't compare a $1 billion project to a $2 billion project. I have to calculate a relative measure. I can't just look at how much cash is generated. I have to calculate a percentage to scale it. That is a fundamental violation of finance principles. No, we want scale to shine through. And rates of return eliminate scale, and that's why rates of return are flawed as an indicator of financial preference. They're an input to, not the goal of finance. Now, if the scale is the same, then rate of return floats to the surface as being relevant. So if I change this problem, if the scale is the same and the cost of capital is the same, then rate of return will be controlling, but this is the only case when it will be controlling. And we see that I've simply doubled the size of the smaller project to make it equal in size to the larger project. Now they're both $20,000 projects. And notice what happens when I do the arithmetic, and that's all this is basic arithmetic here. We get a situation in which now, because the scales are equal, if I could make them equal. Now, you usually can't do this with projects. You can't say, oh, I'm just going to double the size of this project, and therefore I'm going to make more money. You take the projects as they come to you, and if the scales are different, you do the NPV calculations as is. I'm just showing you that if it happened to be the case that the scales were the same, then the rate of return would prevail. But if they're not the same, you have to let that scale difference work its way through. So what did we find? Well, under our initial assumptions, the larger scale trumped the higher rate of return. In that case, we selected the larger project with the lower rate of return. Now, what if it turned out that the scale of the projects had been the same? Then the rate of return would have been controlling, and we would select the project with the higher rate of return. But notice that I can't just look at projects without doing some simple arithmetic, the net present value calculation, to actually see what is better. I can't just say, well, this rate of return is better, so this is the better one. And also, I could develop an example where the scale would be bigger, but the rate of return wouldn't be high enough, and I would get a result in which the smaller project was better. The whole point here is that we have to do the calculation to know which project is preferred. But the reason that corporate finance texts always do an example in which the larger scale one wins is because most people want to think that it's rate of return that matters. And they're trying to show that fundamental principle. These examples come early on in corporate finance books. You want to get people right on out the door. You want to have the right framework. But now, let's put this in context. Is utility scale? Scale can be a really critical variable. Likely to be the same over time if the utility promotes energy efficiency rather than sales? No. The scale is going to be reduced. We're going to shrink our scale relative to what it would be if we didn't do energy efficiency. And the initial conclusion that we would draw from that is, uh-oh, that might cause our NPV to be lower. Now, we have to calculate it, but it's not a good sign when we see that scale is going down. Now let's do equity financing. This is a little more complicated, and this is the part of the presentation that's going to be a little fast-paced for people who haven't had any training in finance. I'm not going to spend a lot of time on it because I don't want to bog down, but these slides are here, and you can go back and see it. So let's go through this fairly quickly so that we can get on to the decoupling part. But I want to show you that everything that I've told you so far is true whether we use debt or equity financing. And here's the simple model for people that want to just get the concept. What is a stock price, and how does NPV relate to the stock price? Well, stock price is really a ratio of the net present value of the cash flows for the company divided by the number of shares. And here's, again, the quick rule of thumb, ad hoc, heuristic way of looking at this. When we invest in a project that has NPV that's greater than 0, the numerator goes up proportionally faster than the denominator. This is over the long run, this is what's going to happen. So we're going to get more cash flow value. We're not going to get dilution. It's called accretion. When you invest in a net present value positive project, you get accretion. If you invest in a net present value negative project, you'll get that dilution. Everybody worries about issuing shares diluting the stock price. Well, it turns out it only dilutes it if you're investing in bad projects. If you're investing in good projects, it actually is accretive to. And so what we end up with is the net effect is the stock price goes up. So when we are doing NPV positive projects and we have to raise equity, we still get stock price accretion. Now I'm going to do this in detailed form, but very quickly with a real example, and I'm going to use the Southern Company, which is a utility. serves the southeastern part of the United States. For some of our international viewers, you may not be familiar with that, but everybody in the United States is probably familiar with the Southern Company. Its book value, its accounting book value is 1805. Why is the book value important? Because that's the number to which the rate of return applies. We can skip this expected dividend payout for a moment and look at the cost of equity for a typical utility today using a discounted cash flow model is about 9 to 10%. So what can we see from this situation? Well, we can see that the expected rate of return on its book value is higher than its cost of equity. That lays the foundation for an NPV positive project. So every dollar that the Southern Company can invest in itself, internally, is going to generate net present value. But I'm going to show you that's going to go to the present investors, not the new investors. Remember when we did that first example and we raised capital, but you received all the benefit? You're the present investor. The new investors didn't get. They only got their principal back plus a fair return. That's an NPV 0 investment. I'll show you that in a second. Okay, here's for the, this is not for the faint of heart if you haven't done much finance, but I'm going to quickly step through that. Taking these assumptions, we can calculate the earnings per share, which is book value per share times rate of return, 244. Dividends per share, this is where that dividend payout comes in. 67% is what the Southern Company pays out. So there's $1.63 per share going out the door as dividends. And I'm not going to spend any time on this last thing except to tell you that this is what's called the retention growth rate. People who are familiar with finance will know what that is. That is how fast your dividend stream will grow in the future, 4.5% per year. Here's the key. If we could control the world and we could buy into the Southern Company at that $18.05 book value, that would be great because we would get $1.63 in dividends. We'd only pay $18.05 for the stock. Just the dividends would yield 9% for us. We're then going to also get this dividend growth rate of 4.5%. We're going to get 13.5%. We're going to capture the gain. If this could happen, we would have captured, as new investors, the 13.5. We would have captured it all for ourselves. So if the required return is only 9 to 10, under this situation, the new investors would get the NPV gains. But can new investors actually buy the Southern Company for $18.05? No. For the very reason that if these net present value gains were just laying on the ground like that, everybody would be scrambling to pick them up. You have to pay $32.50 today for $18.05 of book value worth the Southern Company. What does that do? Well, it doesn't change the dividends coming out. That's the cash machine of the Southern Company. But it does change what you paid for it. So our 9% is only 5%. Now, the dividend growth rate doesn't change either. The dividend stays the same in the dividend growth rate. Because if you think of the Southern Company as a cash-generating machine, the machine stays the same. The stock price is about what you're willing to pay for the output of that machine. And it turns out, look, it's 9.5%, which is halfway between 9 and 10. So the cost of equity, which another term for the cost of equity is the required return, is 9.5. It's halfway between 9 and 10. And you get 9.5. Have you created NPV? No. By definition, there's no NPV. This is another standard principle of finance. The NPV from investing in financial securities is always 0 because the markets don't allow these uncaptured NPV gains to just be there to be plucked by people. The market drives the prices to the point where there aren't any. Now, an NPV of 0 doesn't mean you don't make any money. We saw that you get 9.5%. That's still a pretty good return. You just can't capture that extra return up to 13.5. But think about what we've just shown, going back to our first project, whether that was debt or equity. Remember, the NPV was $11,818 for the preferred project. And I've just shown you that the NPV for new investors is always 0, but NPV is created. Somebody has to get that, and there's only one group left. By deduction, it must go to the present investors. And that's what Myers was saying, that all project opportunities are windfalls. They're windfalls to the present investors, not to the new investors. So who benefits from this bidding frenzy in the Southern Company to get that higher price? Well, certainly not the new investors. They're the ones that pay the new price. They're the ones that actually contribute that extra money. Who gets that extra money, that money above book value? The present investors get it, and they get it immediately. They get it in the form of a higher stock price. So what we've seen is that NPV accumulation goes to the present investors, not to the new investors. Why is that so important? Because that's who the managers work for. Managers do not look out for the interests of people that might be investors. They look out for the people that are their investors. And at the time they're issuing stock, the firm wants to get as much money from the new investors as they can. They don't want to give them a cheap price. They want to have the new investors pay as much money as possible. Why? To benefit the existing investors. This is another fundamental point of finance that's often missed by people who look at energy efficiency investment opportunities. And they say, well, the fact that energy efficiency slows the rate of growth of assets for the utility isn't a problem because those investors can put their capital elsewhere. Well, that's always true. But those aren't the investors that the managers are concerned about. And that's not those investors are not the beneficiary of that expansion. The beneficiary of that expansion is the present group of investors. We'll get to that in a second. But was it that high rate of return that drove the Southern Company's new stock price value to $32.50? This is another subtle point, and I want to do this before I get to that concluding remark. No, it's not just the rate of return. It's back to the combination of three factors: rate of return, cost of capital, and investment scale. The Southern Company has to expand to take advantage of that high rate of return. If it doesn't expand, it doesn't get its full advantage there. So these are always the three: rate of return, cost of capital, and investment scale. And the scale one is the big one for many utilities, but not for all. We're going to get to that in a moment. This is another subtle point. This is the typical utility. This is really advanced finance, so I'm just going to tell anybody who wants to work through this, what I'm saying is if we really slow the Southern Company's expansion down substantially, it could actually stop. It could actually start paying out more of its earnings as dividends. Why? Because of the word that's underlined there. They would not need to reinvest as much, and they could simply pay out. Their scale would be shrinking relative to their expansion path. And if you go through that math, if you're a financial analyst, you'll understand exactly how I derive that number. But here's the key. Here are the results. Notice under two expansion paths, the status quo expansion path, that's the one that we see today. $32.50 is the stock price, and the return on equity is 13.5. If the Southern Company scales back its expansion, it will still earn 13.5 on new investments, but its stock price will only be 28.67. Why? Because investment scale drives stock price as well as return on equity. So the point being, rate of return is not the sole driver of investor value. Now, I know I went quite rapidly there, but for those of you who want to step through it, all the math is there for you. But the point being, notice that it's not just the 13.5 that makes Southern Company so valuable. It's 13.5 plus an expanding scale, and we'll get to that in much greater detail in a moment. So back to this idea, remember our streetwise view of corporate finance? Why does energy efficiency hurt the firm? Because it limits this ability to produce these windfall gains. We want to use other people's money to create windfall gains for our existing investors. That's what the manager's job is in a corporate finance sense. And because energy efficiency limits the scale for a typical utility, they will actually deprive the existing investors of windfall gains. So it's all about scale at this level. Well, I shouldn't say it's all about scale. It's heavily about scale. What did we just learn? Investors want the firm to maximize NPV. Why? Because that will actually drive their stock price. And it's not the rate of return that matters. So therefore, any analysis that says investors prefer or are indifferent to particular options based on a rate of return analysis is incorrect. Or we cannot conclude that it's accurate if we don't have more information. Generally, it will not be correct because the other variables will be moving, and we'll have to analyze all of them to get the answer. Okay, you have just now had the equivalent, the Steve Kihm version of a two-semester sequence in corporate finance and investment theory. But I needed to lay that foundation for you so we can actually talk about utilities and decoupling in more detail. We're talking about utilities already because we looked at the Southern Company. But we're going to now go more and more into detail into the utilities, and then we're going to get to decoupling so that we can apply this framework. Let's look at an expansion path and two alternative expansion paths for utility. This is just a hypothetical utility. On the x-axis, we have years, and I'm sorry, on the y-axis, that should say kilowatt hours or megawatt hours or some kind of, that's the sales growth rate. It's a 2% growth rate. So you're the CEO, your systems planning person comes in and says, here's our forecast. Your financial person says, well, we think we can make 11% rate of return. We think under our regulatory environment, under future conditions, this is what we're going to make. Then your engineering planner says we're going to need to add 3 power plants. I'm using power plants here. If you're in a jurisdiction that has generation that's deregulated, could be transmission lines, distribution systems, substations. If you're in the gas business, could be regular stations, anything that you have to expand. If you're in the water utility area, pumping stations, some capital asset. Under this scenario, we build one in the year 10, 20, and 30. And so doing is going to generate $5 billion in NPV. Now remember, NPV is not a percentage, and it's not relative to anything. It's just a big number, but that's what we want, because that's what we're trying to do, is create big numbers of wealth for our investors. Now the regulator offers a counter proposal. Again, you're the executive, and now you're meeting with the regulator, and he or she says, if you go on this revised path, which is where you will be if you promote energy efficiency aggressively, I'll give you 12% on any investment that you make. So for every dollar you put into the utility on the top line, you get 11%. But every dollar you put into the utility on the bottom, I'm going to give you 12%. Now we should see the flaw in this regulator's logic based on what we did, but let's continue to go. We're going to build fewer power plants. That's actually, if the energy efficiency programs are effective, we should build fewer power plants. That's avoided capacity costs, and we're going to build fewer, and we're going to push them out. So instead of building one at 10, 20, and 30, we're going to build 2, one at 15 and one at 30. And guess what happens to our NPV? Well, we're simply adding less scale. That NPV has got to go down. Now notice for the 2 power plants, we get $2 billion for each power plant. And when we're building 3, we get $5 billion for 3, so that's $1.6 billion. We get more per power plant. But again, that doesn't matter either. That's not what finance is about. Finance is about NPV, which is a big number, just like we talked about. So why is the NPV lower? Fewer power plants and the deferred construction schedule. So here's your choice, executive. This one we're not going to do as an exam because I've already shown you what the answer is, conceptually anyway. Under the base case, you're going to earn 11%. You're going to build 3 power plants, and that's going to generate $5 billion of cash flow. If you push energy efficiency, we're going to get, for every investment, we're going to get 12%. We're going to build 2 power plants. We're going to avoid 1, and we're going to generate $4 billion. So which path is the best one? Your job is to maximize your firm's NPV, which will maximize its per share stock price. Which do you pick, the base case, the energy efficiency push, or are you indifferent between them? Well, this is the only thing we need to look at. It's the NPV. It reflects the scale as well as the rate of return. Again, we've got a situation in which the scale drives the answer here. And in the utility industry, that happens all the time because utility assets are so huge in terms of capital. So the base case is our preferred alternative, even though we make a lower rate of return. Now, those people who are strong proponents of decoupling should be troubled here, because what I'm saying is that even if you decouple the utility, give it its program costs, give it its higher rate of return, this is called the 3-legged stool metaphor. The 3-legged stool metaphor doesn't work. You're still better building power plants. Why? It's not about rate of return. It's about NPV. Now we can talk about decoupling with that whole introduction. What is the objective of decoupling? It's essentially to make the utility indifferent in a financial sense as to its sales growth rate. It's not to encourage anything. It's actually to just, the utility If decoupling works, it will be indifferent as to whether it promotes sales or promotes energy efficiency. It won't care. So, but based on what we just learned, what would we have to show that the utility was actually indifferent? We would have to show that under the expansion path for a decoupled utility, under different expansion paths, so the decoupled utilities promote sales, that same decoupled utility promotes energy efficiency. It matters not that the rates of return are the same, and they would be with decoupling, but that doesn't tell us anything. It's got to be that the NPV is the same. And if you're building power plants under the sales promotion strategy, you're not going to be indifferent. We just showed that the NPV could be higher even if the rate of return is lower. If the rates of return are the same, then investment scale is going to loom even larger. If we maximize the NPV, we maximize the per share stock price as well. They move hand in hand. Rate of return isn't on this screen, and it shouldn't be. So here's the conclusion, and I'm going to show you all the supporting research. Decoupling will achieve its objective, and this is where the subtleties start to work their way in. If we look at finance principles, when the rate of return is set at the cost of capital, if the regulator sets the rate of return that way, then scale doesn't really help us, and decoupling will work. If the rate of return exceeds the cost of capital, I'm going to show you, and this may be surprising to people, that the finance research is very clear that actually that is what happens for the typical utility. The second bullet is the structure under which a typical utility operates. They have a strong incentive to expand even if they can't earn higher rates of return. Why? Because scale will be driving. And that's what the last point is. Earning the same rate of return on a larger investment base, if you're in that second group, it'll push your stock price higher. Let's see if we can, let me see if I can make a compelling case for you of that. But before I go too far, let me tell you that I am not out here alone in the woods talking about this. This is how finance works. And here's a personal correspondence with Mark Barnett, who is a utility stock analyst with Morningstar. He read my article in the Electricity Journal and sent me an email message. I couldn't agree with you more. We, like the imagined utility managers in your examples, prefer utilities with allowed rates of return above the cost of capital and large investment programs. He's looking for utilities that are allowed higher rates of return than their cost of capital, that gap, and then are building. It's the best deal for investors by a long shot. Decoupling does not really enter into the mess. What does he mean by the mess? Well, if you ever tried to analyze a utility stock price in its fullest detail, it's a pretty complicated analysis. We're going to do some fairly simple analysis that's actually pretty powerful in a minute, but he doesn't, if the first condition holds, if you've got rates of return above the cost of capital and a large investment program, decoupling is essentially irrelevant in a strategic sense. It is not going to change the optimal strategy for the utility, and it's not really going to have much of a bearing on the whole financial analysis. So again, I'm not alone here. This is actually standard financial perspective, but if you read a lot of the energy efficiency literature, you would see statements that decoupling makes utilities indifferent to whether they promote sales or promote energy efficiency. We cannot reach that conclusion as a financial analyst. It'll turn out that that's true for some utilities, but we cannot reach that conclusion as a general one, nor can we reach it for the typical utility. This surprises people. Even though Barnett just said that's what I'm looking for, it must be out there if he's looking for it because he's finding it. But don't regulators set rates of return at the cost of capital? The answer is no, they don't. In general, they do not. I'm going to show you two fairly lengthy quotes, but the reason I'm showing you this is I'm going to start with a consumer advocate quote, and then I'm going to have a quote from a group of economists that actually work for utilities, and they're both going to conclude that allowed returns are, in essence, higher than the cost of capital. Here's the consumer advocate. Regulators are supposed to set the authorized return on equity at a level equal to the cost of equity capital. Supposed to. Well, the cost of equity is not, capital is not directly measurable. That's a problem because we can't measure it, but I'll show you in a minute there are ways to get at it. There are many indications, both quantitative and anecdotal, suggesting that the cost of equity in the economy, particularly for an investment such as a utility company that is generally of lower risk than the market holds, is lower than currently authorized ROE levels. Well, they've kind of turned the equation around, but they're saying the same thing. They're saying the cost of equity is lower than the rate of return. I'm saying the rate of return is greater than the cost of equity. Same thing. They just got the variables on the other and reversed on which side they're on. But they're saying what I'm saying, which is the rate of return is higher than the cost of capital. Now look what Myers and Barucki said. They work, Myers is a professor of finance, and I've quoted him earlier, but he and Barucki, Linda Barucki, his colleague, are actually members of the Brattle Group, principals of the Brattle Group, which does rate of return testimony for utilities. And what do they conclude when they studied this? There's no way to square these numbers with the standard view of the objectives of rate of return regulation. Notice how this sounds exactly like Marcus and Mitchell. Regulators are supposed to set allowed returns equal to the cost of capital. And then they go into some, perhaps with regulatory lag, to give incentives for cost reduction and better management. But when you look at the data, this is the key. This does not allow for an expectation of long-run profitability. When they look at expected rates of return, like the Southern Company's 13.5% return, that's well above any reasonable estimate of the cost of equity. Or, as we'll talk about, market-to-book ratio is substantially above 1 for virtually all utilities. When the market-to-book is well above 1, that means investors expect, in the long run, that utilities will be allowed to earn returns in excess of the cost of capital. So we've got a consumer advocate and technical witnesses for utilities agreeing that rates of return exceed the cost of capital for the typical utility. I've written another article that covers this in detail in the December 2000 issue of the Electricity Journal. If you want to follow up on this, it lays out that entire discussion. Plus, it also provides some arguments as to why that may actually be reasonable. And whether you agree with that or not is not important. But the point is, the evidence is pretty powerful that the typical rate of return is higher than the cost of capital, and has been for the last quarter century, and over the last half century, on average, is statistically significantly higher. The rate of return is statistically significantly higher than the cost of capital. So that's what a typical utility looks like. What does decoupling deal with? Here's the hypothetical utility, rate of return on the y-axis, sales level on the x-axis. Allowed return is 11% right down the middle. So regardless of how much it actually sells, its allowed return, which is just a fixture that used to set rates, is unaffected. But its earned return will be affected. Go up to the right-hand side, higher than forecasted sales. The way utility rates are designed, they can include a contribution to fixed costs. Well, if you hit your sales forecast, and everything else is about the same, and you go beyond that, you're going to be generating fixed cost contributions, but you would have already covered them, and so those just flow to the bottom line. Conversely, if you're down at the lower end, the way rates are set, you're not going to have covered all your fixed costs, and you're going to be short. This is the standard paradigm that a decoupling advocate or proponent would work with, and I'm 100% in agreement with them. Notice, though, that these forecast levels lower than forecast or higher than forecast could be due to weather, the economy, or energy efficiency. But clearly, if we promote energy efficiency, we're going to push ourselves down to the left side. And if we promote sales, we're going to tend to push ourselves up to the top side. This is what's called the throughput disincentive. And the throughput disincentive is real. And decoupling does address that. I'm going to show you how it does. This is essentially, this is like a teeter-totter. What does decoupling do? Well, if you make, over on the right side, if you sell more than expected and you generate extra returns, decoupling requires you to refund the extra. If you're at the promoting energy efficiency and you undercollect, you get to charge your customers a surcharge, and we right the ship. The teeter-totter comes back to balance, and there's no disagreement about this, at least not for me and the typical person who promotes decoupling. There is a throughput disincentive, yes, and decoupling mechanisms eliminate that and actually do a great job. So that's not what we're talking. There's no disagreement there, at least, again, not on my part. What's the problem? Well, what was this analysis based on? Rate of return. That doesn't mean, simply because I've fixed the rate of return, doesn't mean I've solved the finance problem. And because it's investment scale, we've got to consider. Investment scale is so important in the utility industry that it actually has its own name. It's called the AJ effect. Averich and Johnson in 1962 wrote what is now a classic article published in the American Economic Review. And look at this sentence, and based on what we've said so far, this should make perfect sense to you. The firm has an incentive to acquire additional capital. why do we try to acquire additional capital? To finance projects. If the allowable rate of return R exceeds the cost of capital K. So if R is bigger than K, what do we want to do? Expand. Now notice this is the term allowable. They're not even worried about the earned return. They're not worried about the throughput disincentive. This utility, right out of the gate, is in good shape because their regulator has set their return at a rate in excess of the cost of capital. Under this framework, here's a very simple way. If you want to boil utility finance down to a simple equation, here it is. The economic value created, that's another name for net present value, that which will go to existing investors and that which will drive the stock price higher, is a function along these lines. The annual return will be rate of return minus cost of capital. If that's a positive number, then we want to add investment. If they're the same, then investment doesn't matter. And if that relationship is reversed, we're actually going to not want to add investment. Now, Gordon tells us how to maximize value under the AJ. Stockholders benefit if the allowed rate of return exceeds the firm's cost of capital. Again, remember, allowed. They're not even talking about a throughput incentive here. They're just talking about if you get a good rate of return, then your AJ effect will hold. But utilities can't just expand willy-nilly. They're subject to regulation. But if you can show that demand has increased, if you can increase your demand so you can build capacity, then you're going to maximize your benefit. This is a prescription to sell more energy so as to build. We're not selling more energy here to maximize rate of return. We're selling more energy here to expand our scale. So if R is greater than, if R minus K is positive, maximize this. But notice it's not about increasing the rate of return. They're holding the rate of return constant. It's about expanding the scale under a given rate of return. So if we can make 12% on $2 billion instead of 12% on $1 billion, and our cost of capital is 10%, making 12% on $2 billion will drive our stock price higher. Why? Because we're creating economic value. But note that if I earn 10% on $2 billion or 10% on $1 billion, the bigger project doesn't make me any more money. Why? Because I don't have any economic advantage. It costs me 10, I earn 10, it's a wash. So when AJ holds, scale matters. When AJ doesn't hold, scale doesn't matter. So here's a real simple graphic, some pictures to help you remember this. If I earn 12 on the capital, how much do I want to raise? Well, if it costs me 10, I want to raise a lot. I have an investment scale incentive. The AJ effect holds. But what if it's 10 and 10? Then it doesn't matter. I can't make any gains on scale because it costs me the same amount as I earn. And what if it's 8 and 10? What if I earn 8? Now I have a strong disincentive. Every dollar I use to expand, I actually hurt myself. The stock price will go down. It's called the reverse AJ effect. So we have actually labels for these in the utility industry because they're so important. Well, based on what I've just told you, there's 3 kinds of utilities: AJ effect utilities, no AJ effect utilities, and reverse AJ effect utilities. Well, what kind of utility is operating in your jurisdiction? Well, if we go back to Myers and Barucki, they use the standard finance principle of the market-to-book ratio. And what this said is if the return on book equity, the rate of return, is pushed back to the cost of capital, stock price gets pushed back to book value. So if we do a little algebra here, they're saying if R equals K, price equals book, price to book has to equal 1 then, using our algebra. That's called the price-to-book ratio or the market-to-book ratio. And here's Value Line. Value Line Investment Survey, for those of you who don't know, the Value Line Investment Survey is a standard publication used. If you go to a utility rate hearing, you'll hear about the Value Line Investment Survey all the time. It's a highly regarded source of financial information. They cover 67 electric and gas investor-owned utilities. And notice if what Myers and Barucki was saying is accurate, and it is, and if the rates of return were equal to the cost of capital, this distribution would be centered on 1. It's not centered on 1. It's centered on 1.32. Now, that doesn't sound like a lot of difference, but what this means is the typical utility stock today trades at a 32% premium to what it would trade at If its rate of return were set at its cost of capital. That's a substantial premium. That means the rate of return is noticeably above the cost of capital. And just as finance theory would suggest, if we look at market to book on the x-axis, expected rate of return on equity in the y-axis, and that's from value line as well, we see a very nice relationship. It's exactly as Myers and Barucki suggested it should be. It works. We can divide our utilities now into the three bins, and here's what we do. If the utility sells at a 20% premium or above, that would be a market to book of 1.2. Think about that. That's a fairly sizable premium. We're going to say the AJ effect holds. If it trades at 0.8% or below, that reverse AJ effect, where the rate of return isn't high enough, and everybody else is in this no AJ neutral zone, limbo zone. Now let's look at a utility that is clearly subject to the AJ effect, and this is our friend, the Southern Company. This is from the Morningstar report. And let's look at this red text. The market to book is 1.7. 13.5% ROE. That's clearly higher than the cost of capital. And this is a utility. The Southern Company is essentially a regulated utility. Any non-utility operations it has are marginal at best. Enviable regulatory relationships. What does that mean? The Southern Company has worked with its regulators to the point where it gets rates of return coming out of the gate, as I said, that are high. They don't even have to push to get higher rates of return. They already have them. It's a pure play regulated utility, meaning it's not making a lot of money from non-utility operations. It's averaged more than 14% return on equity for the past 5 years. For those of you who are utilities watching this, can you imagine making 14% on equity year in and year out? That's a great return. It's largely because they've got good regulatory relationships. Now, whether you think that's good or bad, I'm not weighing in on that because we're talking here about finance. I'm taking this as a given. I can't change that regulatory relationship. If you think you can change that, you should be able to get utilities to do energy efficiency. If you can just change that, boy, you're a very powerful person. That has taken decades for the Southern Company to develop. Very difficult to overturn that. So what should the Southern Company be doing if I'm right? If this market to book says they have an incentive to expand their scale? Well, in the past, what has driven their profits? Rate-based investment. Looks pretty consistent with finance. What is it going to do in the future? Value Line Investment Survey. Georgia Power, which is one of the Southern Company subsidiaries, has requested construction and operating licenses from the NRC for 2 units at its Plant Vogtle station, two nukes. And Mississippi Power is proposing to build a 580 megawatt coal gasification plant at $2.2 billion. It's going to expand. It's going to add scale. That's what it should do. It gets an A+ in finance. It's doing exactly what it should. Now, whether you like these results in a public policy setting, again, is not the scope of this talk. I'm talking about corporate finance, and this utility understands corporate finance and is doing it exactly correctly. And this is the disincentive. If you want to change its perspective, you have a lot of work to do, and decoupling will not even come close here to changing this utility's perspective because it's about scale, not rates of return. It already gets the rate of return from its regulator. So what does the Southern Company do with respect to energy efficiency? It's a $17 billion revenue company. It spends $70 million on energy efficiency. So it spends some on energy efficiency, 0.4%, but those in the energy efficiency community know that there are some utilities in the United States that spend about 4% on energy efficiency. That means the Southern Company spends about 1/10 of what an aggressive energy efficiency utility would. But from finance principles, that makes sense. But Ameren also gets an A in finance. Why? It's reducing its capital budget. Well, does that make any sense? I just said the Southern Company gets an A because it's increasing its capital budget, and Ameren gets an A because they're reducing it. But look, they're a reverse AJ effect company. Every dollar that Ameren invests, it's going to drive its stock price down, so they're trying to shrink capital. Now, this is the most interesting utility, and this is probably going to create a lot of controversy. So let me just throw this out there, and you can think about it. PG&E has a market to book of 1.5. What does that tell me? Strong AJ effect. This utility should want to expand. But wait a minute. PG&E, it's decoupled. It has an energy efficiency performance incentive. It has a way of collecting its costs. And it's aggressively pursuing energy efficiency resources. True. Everything up to this point is true. But the question is, what are investors looking at? This in finance? If I'm right, investors should be looking for the utility to expand. They shouldn't care about decoupling or energy efficiency. And they don't. Value Line Investment Survey, Pacific Gas and Electric is building 2 gas-fired plants. When these facilities are completed in 2010, they will add 820 megawatts of capacity at a cost of $912 million. And this follows the completion of a plant earlier. Decoupling and energy efficiency do not appear at all in the Value Line Report. It's all about building plants. So even though there is a structure in place in California, and even though the utility is responding to it, investors are still looking for scale. They want PG&E to build, and PG&E is building. But still, we have to step back for a second. This seems to be kind of a traffic jam or a traffic accident of different forces coming together, and it is. I'm only talking about the financial piece, and I've shown you that PG&E has an incentive to expand and add capital, and PG&E is complete. My trail is complete. But we also know that PG&E is an aggressive energy efficiency promoter, and they're doing a great job, and so is the California Public Utilities Commission, which has set this up. But what's happening here is a political economic structure. Finance is only one piece, and the utility has to do the best it can under the confines established by the California Public Utilities Commission. Can PG&E just say, I'm going to avoid energy efficiency and build some nuclear power plants like the Georgia Power or Southern Company is? No, not really. California Commission won't let it do that. So, but the thing to realize here is even PG&E, even with that complete incentive system, still has an incentive to expand, and it is expanding. Now, I'm not saying anybody's doing anything wrong here. I'm just saying we have to recognize where the incentives lie. So what are the 3 groups? AJ effect holds. 2 disincentives to do energy efficiency. A small one, which is the throughput disincentive. A big one, which is the investment scale disincentive. How about the middle group, no AJ? There's no investment scale disincentive. Why? Because they make the same rate of return as the cost of capital. Doesn't do them any good to expand. So the throughput disincentive is the only one that matters. And decoupling is going to work here. Why? Because decoupling works on the throughput disincentive. But what about this group? This is the interesting group. Reverse AJ, they always have the throughput disincentive. The less they sell, their ROE goes down. But they have an investment scale reduction incentive. They don't, remember Ameren cutting its capital budget? So they have these conflicting objectives. But whenever investment scale incentives or disincentives are operating, they tend to trump throughput. And we'll see that in a minute. And here is where we've actually bring it all together into a financial model, a stock pricing model. We're going to use Gordon's model, his dividend discount model, and I'm going to go through this very quickly because I want to get to the scenarios. This is a standard stock pricing model. It's a variant of the dividend discount model. If you want to follow up on that, go to Gordon's Cost of Capital to a Public Utility book. It's a great book. It's very thorough, really good. What does this model say? P is the stock price per share. N is the number of shares outstanding. B is the book value per share. R is the earned rate of return. K is the cost of capital. And I is the investment opportunities going forward. But just look at this equation for a second. Can you see why we can't just use rate of return to tell how a utility is going to act with respect or prefer a particular course of action? Look at this complex structure that drives stock prices. But I want you to focus on the equation for a second. This equation actually reveals much more than it first appears. Throughput incentive, that's it. N times B times R. What is that? Aggregate earnings. Number of shares outstanding times book value per share gives us book value in terms of billions of dollars times the rate of return, earnings. So if R goes up because we sell more, that aggregate earnings figure is going to go up. If R goes down because we sell less, that's going to go down. Right there in the equation. And what's the second term? The AJ effect. If there is one, it's going to show up there. And I'm just going to skip over these next slides because we've covered this. If R is greater than K, R equals K, R less than K. Those are the 3 groups. But look at this. What Gordon's model says, there's a throughput effect and an investment scale effect right in the stock price model. It's right there for us to see. So this is a wonderfully powerful model. I'm going to run scenarios now, but in all scenarios, these are simply foundations that are going to stay the same. The book value is $20 a share. Cost of capital is 10. Shares held by present investors, 1 million. And we're going to get our capital from new investors. But I'm going to allow the rate of return or the regulatory climate to change. I'm going to have one scenario in which the AJ effect holds. I'm going to set the rate of return at 12. Remember, the cost of capital is 10. I'm I'm going to have one where I set the rate of return at the cost of capital, and then a third one where I set it at below the cost of capital, which gives me the reverse AJ. My strategic choices as a utility, you can play along here. You're the utility executive. Your earned return will be your allowed return plus 50 basis points if you promote sales. Why? Throughput incentive. Business as usual, you're going to hit your allowed return on the head. What if you promote energy efficiency? Allowed return minus 50 basis points. Throughput disincentive. What if I decouple you? All I do is get rid of those extra basis points, and everybody makes the allowed return. If I promote sales, I'm going to build a $30 million plant. If I have business as usual, I have to build a $10 million plant. But if I can promote energy efficiency, I don't need to expand at all. When I say don't need to, that should actually ring some warning bells for financially oriented people. It could be I don't get the opportunity to build any. Then let's see how this plays out. So here's my first scenario. I put all of those numbers into Gordon's model. And what do I find? The optimal strategy, if the AJ effect holds without any decoupling, and this shouldn't surprise anybody, is to promote sales. I've got a throughput incentive and an investment scale incentive. What are the rates of return? Well, I already showed that if you promote sales, you get 50 basis points more. If you promote energy efficiency, you get 50 basis points less. What does decoupling do? Fixes that. But it doesn't do anything to the investment scale disincentive. And so guess what happens? Yes, we knocked our stock price down from $32.50 to $30, but look at your choices. Which is your best strategy? It's still to promote sales. Your rate of return isn't any higher because decoupling took care of that, but it's about investment scale. This utility is like the Southern Company. Notice just by accident the price is $32.50. I didn't mean that to come out that way. It just happened to have the same price. But this is an analog to the Southern Company. Notice its stock price is still much higher. Look what it would be if it promoted energy efficiency and under decoupling. Its stock price would be $6 per share less. And you can make this come out in different ways, but you can't make, if the AJ effect holds, it'll always be the case that this will be the optimal strategy. What if no AJ effect holds? Rate of return is 10%? No decoupling? Again, though, not surprising. This is the thing that decoupling advocates are trying to change. The optimal price, the optimal strategy is to promote sales. And now watch, here's the magic slide for all the proponents of decoupling. This is when decoupling works. We've got the rate of return problem, the throughput incentive and disincentive. Decouple, it works. This is what decoupling advocates intend. And decoupling does work. So if you're in a jurisdiction where rates of return are equal to the cost of capital and consistently held at that level, decoupling will actually do it because there's no investment scale incentive. You're home free. The reverse AJ effect one is actually the most interesting. Notice that the optimal strategy is to promote energy efficiency even if you're not decoupled. Why is that? Well, the model tells us why that is. Is it because the rate of return is higher? No. The rate of return is the lowest, but the stock price is the highest. Remember, rate of return is not indicative of financial value. It's scale. This utility is not when we promote energy efficiency, we don't have to add any plant. The last thing we want to do when we have a market to book well below 1 is add plant because it's actually just going to make our stock price go down even more. If we decouple the utility, well, we get a little bit better price, but it was already the optimal strategy. So we don't really need decoupling in a strict financial sense. We might give it to this utility because it's in poor financial shape, but we don't need it. Here's the summary of all my research. If the AJ holds, what is the strategic implication? Does it change the utility strategy? Does decoupling change the strategy? If the AJ effect holds, no. The optimal strategy is the same under decoupling as it is without it, promote sales. What about in the middle? This is where decoupling works. The utility's optimal strategy shifts under decoupling from sales promotion to one of indifference. And decoupling has achieved its objective. It's done its job. But what about in the reverse AJ effect? Utility's optimal strategy is the same under decoupling as it is without it. But in this case, it's to promote energy efficiency. Now, here's a really critical point. Some people would say, well, why don't we just decouple the utilities anyway, and we'll get all the ones where, if we're not sure if the AJ effect holds, we'll get them all anyway, and it doesn't really hurt anything. That's incorrect. Notice that when the utility was subject to the AJ effect and it was promoting sales, when just that act of implementing decoupling cut 8% off the stock price. Why? Because we didn't take the scale incentive away, but we took the throughput incentive away, the smaller one. So Does decoupling change the utility's optimal strategy? No, because we still have the scale. But have you made the utility executive angry? Very much so. You've simply taken money off of his stock price. And here's my little caricature of myself here. This is me in my energy efficiency outfit. So I've now decoupled you, knocking $2.50 off your share price. Can we get together so I can offer suggestions as to how you can expand your energy efficiency programs so I can actually knock another $6 off your share price by getting rid of your investment scale opportunities? This is not the way to collaborate. By simply hurting the utility but not changing their optimal strategy could give us less energy efficiency down the road. You're simply creating enemies and alienating the utilities if you decouple utilities subject to the AJ effect. This is where we're going next with this analysis, and I'm working right now, just started this work with George Edgar at Wisconsin Energy Conservation Corporation and Pete Kappers and Chuck Goldman at Lawrence Berkeley National Laboratories. We're going to be analyzing how risk affects all of this. And that's actually going to be an interesting issue. But it's not going to actually reduce the answer down to a single entity. We're probably going to end up with more groups. It's going to be about what is the risk going to be in the future, and utilities are going to have different views of that. So they're going to be starting from different positions, and then they're going to all have different views of what the future is. We're going to get more groups. We're not going to be able to draw general conclusions about decoupling, even with this risk analysis. This is really important, but it's not going to overturn the structure. The structure is going to be the same. And I'm actually excited about trying to find some situations in which we can make a more compelling case for energy efficiency once we enter and introduce the risk variable. I'm actually optimistic that in some cases we will be able to. I am not, though, sanguine that we will be able to do it in all cases. I'm just not sure. That's the next area of research. Just about done here. Incentive structures vary from utility to utility. If that's the case, the solutions will vary as well. We can't draw a general conclusion about decoupling. It works in some cases. It doesn't work in others. And that's because investment scale sometimes swamps the analysis. I'm talking about financial incentives. I saw with the Pacific Gas and Electric PG&E case, political economics really come into the analysis as well, as does risk. So that's going to make the analysis even more complicated. But what we should do when we're thinking about the financial components, this is my ultimate pitch to you. Let's think about it using finance principles, which is NPV and stock prices, not rates of return. Let's do it per finance principles, and we'll get conclusions that have a solid basis. Okay, this has been a very fast-paced webinar. I'm sure a lot of you have questions, and we've probably had questions that have come in. If you have questions after the webinar, or if you're watching this in an archived fashion, please send me a message. I will try to answer them or refer you to a source that can help you out with that. There's my email address. Now, one last housekeeping matter before we go to the Q&A. It would be very important, it's very helpful to us if you could give us feedback on this webinar. So if you could hit your touchpad or your mouse, and if you look down, and this is true even if you're watching in archived mode, there's a little eye. If you click on that, we've got some evaluation, an evaluation form that you can fill out. All right, with that, I'm just about out of breath, and I think I'm going to see if Andrea has some questions for me. Okay, and she in fact does. Okay. So, okay. All right. So let's see if we can go through these fairly quickly. How can I get a copy of Steve's slides from today's webinar? That's that same process that we just talked about. If you link onto the I, it's in there in PDF form. Okay, so if you want the slides, they're there. But also remember, if you want to share this with someone, you can share the archived version. This will be on our website in a day or two, and so you can see the whole presentation if you want to have me talking with the slides. Is the rate of return the same as return on investment? Well, for all practical purposes, yes. The rate of return is a general term, and return on investment is also a general term. They're both percentages, and yes, so in everyday regulatory language, those would be the same. If there is a longer time period, this is a good question, then does the denominator that you divide by just increase by how much? This is a really good question. And this is what I can't do in a 1-hour webinar. all of the conclusions that I presented today are qualitatively the same, regardless of how the time period changes or anything. But if you want to get the quantitative answers, then you have to simply go to a spreadsheet, put your cash flows in, and analyze it. And you can vary the time period, and you can see what happens. So it's a good question. I can't do that analysis for you today, but you're on track. But if you do the analysis correctly, you'll get exactly the same qualitative results. What is the measure of scale? That's a good question. Now, that's actually a really good question. Ultimately, it's NPV scale. That's the scale that matters. But in terms of an input, it's usually the capital contributed. So if it costs you $2 billion to build a power plant, that's that scale. If it costs, let's say that's a coal gasification unit, and if it costs you $750,000 or $750 million to build a combined cycle plant, it's usually the contributed capital. That's typically the scale that we're talking about. Okay, where is decoupling working successfully in the U.S., and which utilities are successfully implementing it? Okay, that is a little bit beyond the scope of my presentation, but I think we will find that let me use the California example because that is so complicated to show you why this is a difficult question to answer. California is decoupled. It has a performance incentive, and it recovers its program costs, and it's producing energy efficiency gains, which are great. Well, what's causing that? I think it's the political economic combination of finance and everything else that's in the mix. I can't say, oh, it's decoupling caused that. I suggest that, I'll give you a place that you can go, because the Regulatory Assistance Project, which is a good group of people that really promote decoupling, they're probably going to be able to answer that. So if you just Google RAP online, now they have a stronger position on decoupling than I do. They think it's more effective than I might think. But as a resource, the Regulatory Assistance Project, I suggest you check with them. They may have better information on that. Mine is an incentives analysis more than a measurement of impact. How does the relative risk associated with different resource paths affect your assessment? Very good question. This question probably came in before I did this slide, but that's exactly the next area of research. That's a great question. What if it's more risky to build a power plant than to promote energy efficiency, which it probably is? Well, then the cost of capital, which I've held constant throughout this entire presentation, starts to change as well. Now I've introduced a new variable that changes. But be very careful not to jump to a conclusion there, because people say, oh, building power plants is riskier, so therefore the whole analysis comes back to we should still do energy efficiency. It might, but let me give you a counter argument. I'm not saying that's wrong. I'm just saying that we need to analyze that one just as closely as we did the analysis we did today. The Southern Company is building those nuclear power plants. The Obama administration and Secretary Chu have decided to guarantee the debt for the nuclear plants for the Southern Company. Now think about what the Southern Company is probably the least risky entity in terms of a utility in the nation, and the federal government is guaranteeing its debt on its nuclear plant. That suggests that maybe building that nuclear plant isn't as risky as you might think. That doesn't mean we've resolved all the risk there. There's still some business risk there. Could be big business risk. But I can't give you a general answer to this problem. The other issue, what if regulators pass on the higher risk in terms of a higher rate of return? I don't know if they'll do that. I'm not trying to poo-poo this idea because I think it's a great idea. In fact, I had a great exchange with Rich Sedano, who is from the Regulatory Assistance Project, and that was his point back to me. It's a good point. What I don't want to take, if I'm an executive, I don't want to take on this kind of risk because I might not have the AJ effect in the future. Fair enough. You might not. However, I don't think the Southern Company is worried about that, and probably rightly so if the federal government is guaranteeing the debt on their nuclear plants. So this is a great question. We could have a whole webinar on this question, and maybe in a year we will. But so very good question. When the discount rate can fluctuate widely over the next 5 to, how accurately can NPV be arrived at? So in other words, how can we be sure that we actually have the right discount rate or the cost of capital? Another good question. It actually is it's a companion question to the risk analysis. But let's say I can't get my hands around that very much. Does that mean that the analysis that I've done is not useful? No, it's the only way we can do finance. We're going to have to deal with sensitivity analysis then. We're going to have to try different discount rates and see if we get different conclusions. So the framework does not change just because it's hard to come up with the values of the inputs. The framework is the same. And this one suggests sensitivity analysis. Can incentives offset investment scale? Great question. They can only offset, well, let me answer that in two ways. Let's say we capitalize energy efficiency to create the investment scale. So instead of building power plants, we're saying you can earn a return on your energy efficiency investments. Well, that doesn't work because unless the energy efficiency capital expenditure is of equal size. So if you're trying to defer a $10 billion nuclear plant, or eliminate that, I talk about this in my paper, and the AJ effect holds, how big does your energy efficiency portfolio have to be? 10 billion. You got it's dollar for dollar on scale. But if you mean incentive payments that are just over and above, remember that example that we did early on? No, it won't necessarily. Can it? Yes, if you give a high enough rate of return. Remember this scenario? There's an incentive of 12%, and under this hypothetical, it didn't. Could it? Well, if maybe you made that 15%, you might be able to do that. If scale trumps return, why don't decoupling proponents allow utilities to earn a return on EE investment? Okay, this is the question I just answered. It won't work unless the scale is, if scale matters, what is scale? Dollars. So if a $10 billion plant and you want to make the utility have NPV 0, $10 billion energy efficiency portfolio. Well, that kind of defeats the purpose. So when this is like an antibiotic-resistant disease. It's so difficult to overcome this AJ incentive. It's almost impossible when it's strongly entrenched, because every time we try to twist and turn our model, it's so difficult. But do you understand why that's the case? Scale is about dollars. And if we're getting rid of a $10 billion plant and replacing it with $1 billion of energy efficiency that earns a rate of return, they both earn a rate of return, I'm just short of the utility $9 billion of investment scale. Can't do it unless you make the scales the same. Does the same analysis apply in large investments in conservation programs with an allowed rate of return? I think that's the question I just answered. The model is the same, but run the model. Take a nuclear plant through the model, and then take an energy efficiency program that's going to be a smaller scale and run it through the model. If the rate of return is the same and the AJ effect holds, I'm going to tell you, I can tell you right now, the nuclear plant comes out better. But here's what you can do. Now that you see the model, try this. Try the $10 billion nuclear plant, but raise the cost of capital on the nuclear plant. Say it's not one that has its debt guaranteed by the federal government. And then also lower the cost of capital on the energy efficiency investments and give an incentive payment to the energy efficiency. So you see what I'm doing? I'm starting to change all the variables. Now you have a model that will allow you actually to get an idea of how hard do I have to work to actually get the utility back to NPV 0. But notice I can play with scale. I can play with rate of return. I can play with cost of capital. And when I mean play with, I mean that in a serious way. I can try to come up with reasonable estimates of each of those variables. But this is the whole thrust of my presentation. I can't answer this question. How is it going to come out? I don't know. Depends on what inputs you put in there. Is it conceivable? And this is really where my future research is going with the gentleman I mentioned earlier, is I'm going to see if we can develop scenarios, reasonable scenarios, in which even if an AJ effect is holding, that the utility actually is still better off doing energy efficiency. If I keep it in the confines that I've operated today, I can't do it. But if I start to change risk, cost of capital, and allow for differential rates of return and scale differences, I actually think we're going to find some scenarios where it actually is. Now, I do not think we're going to find a panacea or a silver bullet. I do not think we're going to find that in all cases I can make every utility indifferent between sales promotion and energy efficiency. I don't think I can solve the Southern Company problem, for example. It's too well entrenched. It's got high rates of return. It's got federal loan guarantees. I think those nuclear plants are going to get built. Do I think that's the best public policy? I'm going to switch hats here for a moment. No, I think energy efficiency is a lot more cost effective. But do I think the Southern Company is going to have an incentive? Can I make it like energy efficiency as much as it likes building nuclear plants and coal gasification plants? Unfortunately, I can't. This is a finance seminar. That's what's going to happen. That's my prediction. So that completes the questions that we got. If there are more that are coming in, I'd be glad to try to answer them, or I will answer them via email. And with that, I think we're done. Thank you. Appreciated your questions, and thank you for staying with me on this fairly fast-paced and hopefully informative webinar. Thanks.